Hey there, everyone. I've got a new topic that I think is really relevant right now. It's a real hot opportunity coming up over the next year or two, and it has to do with tapping into your low interest rate when working with people that are interested in buying your home. Back in the 90s, these were pretty hot options for getting out of higher interest loan offers and being able to take a lower interest loan option. They called it an assumable loan. I want to kind of cover this in a real concise way. This should be a short video, but I think there's going to be a lot of good relevant information for those that are looking to sell in the future or don't think they can sell because the interest rates are 7.5%, 8%, and the buyers aren't coming or they can't afford to buy another home because of it. These are all really good concerns. I think I've got some options and things to think about. But initially, I kind of want to cover it real quick about what it is, if you have one, what can you do with it, how do you leverage it when selling a home, and then what the challenges you'll come into by using them, and then what a assumable loan is not. I think that all of those are real relevant things for you guys. So they are currently making a comeback, and it's certainly impacting real estate and the real estate market now. I'm going to give a specific example as I just am close to finishing my first assumable loan contract. Obviously, the biggest thing is the last 3-4 years we are having interest rates in the twos and the threes, likely never happen again. But it gets an opportunity for people selling and they're not able to move their property or just aren't getting the interest that they're hoping for. This gives them a way to offer a option for another buyer to come in and then assume their loan. Where the buyers currently are getting 6, 7, 8% interest rate options. Another real clever option here is it gives them an option to compete against construction homes, right? New home construction. I just worked a deal with the new home construction. The builder is giving them $30,000, which reduces their interest rate probably about 2.25. So now they're in the fives, high fours, fives, which is really attractive when your other competing retail used home is going to be charging you 7.5+% to do a loan. So that's a real clever opportunity that builders are using to try to attract more people. It can really help sellers gain leverage in negotiations. So if I have a buyer and they're making an offer on my home and I'm able to offer them a 2.5, 3% interest loan, and it saves them $400 or $500 a month, it's certainly a lot harder for the buyer to say, hey, I want to, knock $10,000 off your house when you're saving me $6,000 a year in interest. Or, I want you to repair every possible item in the home so I have no worries. Again, when you're saving an enormous amount of money, because there's not that many properties out there that are even offering this. I was going to talk a little bit about what it looks like in the market as well in just a moment. How do you know if you qualify? So I'm going to kind of go through this pretty quick. I want to make sure I cover the things that most people are interested. Conventional loans typically do not offer a assumable option. They're normally government-backed loans, USDA, VA, and then the most popular FHA. I heard someone tell me that all FHAs offer an assumable option. I haven't verified that, but that's normally where most people are getting the benefit and being able to offer it is through an FHA loan. I know that right now, it's a real small part of the current market is even taking advantage of this opportunity and they're listing. Some people have homes that have been listed for 2-3 months, and it would be a good idea to go back to the seller and say, hey, call your servicing company. Let's see if we can look at an assumable option to offer potential buyers. I looked in our current market. I'm in Dallas, Fort Worth, Netris. There's numerous homes for sale, over 5,000. And there are only about 150 to 200 homes that are even listing as an assumable option. That's a very small percentage. So that's something I would expect to really expand over the next couple of years, especially if the market stays really tight. There are challenges you will need to overcome when you're offering an assumable loan to buyers. First thing is you got to get approval through your loan servicing company. Second thing is buyers will need to qualify. It's an assumable, meaning you have to assume the loan. You still have a qualifying event in order to assume it. You got to have the credit and the income. Competition on rates. If you have other competing houses in your neighborhood or your area that's offering assumable, for example, I had two. One was at 3.5 FHA. The other one was a 2.3 VA. There's some competition there with other assumable loans. That's certainly a challenge. The length of time to close is long. And I'm not going to go through the detail why. I kind of anticipated it whenever I encountered my first assumable loan. I gave everyone warning up front. Lenders are not really set up or prepared to handle this, certainly not in volume. But they're 45-day plus is what I'm hearing that lenders are putting out there for people to on trying to get an assumable loan closed. Where I can close a loan in 2.5 months with several of my lender partners, or 2.5 months, 2.5 weeks, with several of my lender partners. So 45 days doesn't sound very good, but it does when you're saving several $100s a month in interest. But I'll tell you the number one challenge you'll have is when it comes time to work a deal. Remember, you're only assuming the loan part, not the equity, right? So let's say the house is $300,000, the loan is $200,000. You still have to come up with the $100,000 shortage to satisfy the seller's asking price and be able to close that transaction. There are unique situations where we can get a second lien to cover a large part of that. Another conversation, another day, but there are ways that I've been able to kind of resolve and solve these problems. What assumable loans are not? They're not owner finance. That's where the seller continues to hold their current loan, and then they do something called a wrap agreement or wrap document to allow them to work out terms unique with the new buyer. So they may have a loan at 4 or 5%, and then the new buyer's at 10.99%, and then they work out the terms and equity cash deposit required. Whole different deal. That is not what we're talking about here. Subject to loans. That's another situation where the seller retains the current mortgage and the buyer agrees to make the seller's payment directly for a set period of time and typically have a balloon, so they don't carry them forever. But they get full control. The buyer gets full control over what happens to that house on a subject to loan. And then they have non-qualifying assumable. Not this either. Don't really exist anymore. I give you the technical answer, another time. But really, there's just not any non-qualifying assumable loans out there at this point. They've kind of all exhausted or been refinanced out or sold. So I know it's a lot of information. If you have questions or anything on assumables, I've had a great amount of success in working with a couple of my buyers, getting them into properties they never could have worked out or afforded because the PITI, the principal, interest, taxes, and insurance drops so much by having that low interest rate. This creates a really cool opportunity for them. You guys all have my contact information. Reach out if you have any other questions. Thank you.